Imagine standing at the edge of a colossal wave. Behind you, years of quiet buildup. Beneath your feet, the shifting forces of supply, innovation, and human ambition. Now, the crest is rising. Silver has reached new highs, not because it's flashy, but because it's inevitable in markets as in life. The true edge isn't in predicting the wave, it's in understanding how they form and having the conviction to ride them once they break. The world is waking up to a reality that has been quietly forming in the background for years. Silver, long seen as gold's poor cousin, is no longer just a monetary relic or a speculative play. It's now a fundamental commodity at the heart of the global transition to new systems, technological, economic, and energy-based. And as with all systems, when the inputs are misaligned, when demand is quietly accelerating and supply structurally constrained, a rebalancing must occur. That rebalancing doesn't happen smoothly. It comes in jolts with consequences. We are now approaching one of those moments. The foundation of this shift is simple. Demand for silver isn't just rising, it's evolving. Historically, silver has played dual roles, part monetary asset, part industrial metal. But today, the industrial side has become dominant. Over half of global silver consumption now comes from industrial use, and that percentage continues to rise. Why? Because the technologies that define our future solar energy, electric vehicles, semiconductors, and artificial intelligence infrastructure all depend on silver. It's irreplaceable in those systems due to its unique conductive and reflective properties. You can't just swap it out, and the more the world pushes toward renewable energy and electrification, the more silver it consumes. Consider the solar industry alone. Silver is a key material in photovoltaic cells. Each new solar panel requires a fixed amount, and with global initiatives pushing for decarbonization, the demand curve is not flattening, it's steepening. Then add in electric vehicles, which use twice as much silver as internal combustion engines. Layer on 5G technology, medical equipment, and rapidly expanding AI data centers, and the scale of demand becomes both structural and exponential. Now look at supply. Mining output has not responded in kind. In fact, the global silver supply has stagnated over the past several years. It takes time, capital, and geopolitical stability to bring new silver mines online. That's not happening at the pace people assume. Many of the world's largest silver producing regions are also facing higher regulatory burdens, declining ore grades, and inflationary pressures that reduce project viability. Recycling isn't making up the shortfall either. In many industrial uses, silver becomes non-recoverable, locked into products that won't return to the supply chain for decades, if at all. So we have an imbalance that's not just cyclical, it's structural. You have accelerating demand driven by global trends that are unlikely to reverse, and a supply chain that's constrained by systemic limitations. That's not a temporary mismatch. It's the kind of divergence that ends with repricing. Markets may ignore it for a while, but they can't do so indefinitely. Eventually, price is the mechanism that restores equilibrium. And in this case, restoring equilibrium may require a significant upward revaluation. This isn't about speculation, it's about logic. When the fundamentals change, prices follow. When the cost of inaction exceeds the cost of adaptation, systems shift. That's what's happening in silver. And what makes it more compelling is that most of the world hasn't yet processed this. Investors are still looking at silver through old lenses, trading it on narratives rather than balance sheets and flow charts. But the truth is already on the ground. Factories are consuming it faster than miners can produce it, and the delta is widening. If you understand cycles, you understand what comes next. When structural supply deficits meet unstoppable industrial demand, there's only one way the story ends. Not in a straight line, not without volatility, but with a correction so pronounced that it resets how the asset is viewed entirely. That's the moment we're walking into. The signal is there if you're willing to look past the noise. Markets don't move randomly. They move because of forces, economic, psychological, structural. And every so often you see a pattern, not just on a chart, but in the convergence of these forces that tells you something big is coming. Right now, silver is showing us that moment. It's forming a long-term technical breakout, one shaped by years of compression, neglect, and mispricing. And if history is any guide, this isn't going to be a small move. This is the kind of formation that doesn't just change prices. It changes perceptions. For more than a decade, silver has been trading in a wide, choppy range. Every time it rallied, it got pushed back down. Every time it fell, it found new support. But this wasn't chaos. It was pressure building. And when you zoom out, particularly on quarterly charts, you see the shape of that buildup, a classic cup handle pattern. These aren't mystical symbols. They represent underlying psychology, long periods of distribution, capitulation, accumulation, and finally anticipation. It's the market slowly positioning itself for a repricing that's been postponed for too long. What makes this setup so rare is the time frame. This isn't a few weeks or months of consolidation. This is over a decade of pent-up energy. That kind of duration matters because when a market breaks out of a long-term structure, the resulting move often matches the length and depth of the pattern that came before it. It's a rebalancing, and it tends to be explosive because the crowd doesn't believe it until it's already in motion. But the chart is just the surface. What drives these technical shifts is always rooted in fundamental change. In silver's case, we're seeing a confluence, supply deficits, rising industrial demand, geopolitical instability, and a weakening faith in fiat currency systems. These are all pressures beneath the surface, quietly loading the spring. And when price begins to reflect these pressures, when it starts moving above resistance zones that have held for years, that's when sentiment turns. That's when inertia flips into momentum. Most investors don't think in these terms. They chase trends only after they're obvious. They look at breakouts as short-term trades, not signals of deeper structural change. But when you take the longer view, you understand that a breakout isn't just about price, it's about regime shift. It tells you the market is starting to price in a new reality. In silver's case, that reality includes inflation protection, industrial necessity, and a reevaluation of scarcity. The setup today mirrors moments in the past where silver re-rated dramatically. In the 1970s and again in 2010, the metal experienced parabolic moves not because people suddenly discovered silver, but because the market finally had to reconcile supply and imbalances and macro uncertainty with a price that had been held down by inertia and disbelief. That's what technical breakouts do. They force recognition. What's different this time is how broad the base is. This isn't just about monetary fear. It's about real, measurable industrial use. It's about strategic demand from sectors that are growing regardless of interest rates or central bank policy. It's about a supply chain that cannot scale fast enough. And when a market built on that kind of base breaks out, it doesn't just go up. It redefines the range it trades in going forward. That's where we are now. Silver is pressing against its upper boundaries, and every close above resistance is another crack in the dam. You don't need to guess the exact day it breaks. What matters is recognizing the structure, understanding the forces behind it, and positioning accordingly. Because once that breakout confirms, the speed of the move will catch most people off guard. That's how markets work, first slowly, then all at once. When you look at the trajectory of human development, when you study how societies evolve, how economies scale, and how technologies embed themselves into the structure of our lives, you begin to notice certain patterns. One of those patterns is that every major transition requires a set of core materials. Steel built the Industrial Revolution, oil powered the 20th century, and today silver is stepping into that role, not loudly, but necessarily. The data shows it clearly. Silver is being consumed faster than it can be replaced, and it's happening in the sectors that will define the next 100 years: electronics, renewables, and artificial intelligence. The rise of digital systems has not been linear, it's been exponential. And as more devices, networks, and machines become part of everyday life, the demand for conductive, resilient, and adaptable materials increases. Silver isn't just another metal in this story. It's the most electrically conductive element on Earth. That's not speculation, that's physics, which means when performance matters, when efficiency and scale must align, silver becomes the default, not the alternative. Take electronics. Every smartphone, every laptop, every server, every piece of modern communication hardware contains silver. And as devices become more complex and more ubiquitous, the consumption curve gets steeper. We're no longer in a world where a handful of manufacturers produce consumer electronics for limited markets. Now, billions of people expect real-time data, high-speed connectivity, and devices that sync every aspect of their lives. Each of those systems, in ways often invisible to the end user, depends on silver to function. It's not ornamental, it's integral. Then there's renewable energy. The push towards solar power is no longer a debate. It's a policy. It's a necessity. Climate targets, economic incentives, and consumer behavior are all aligned toward green energy, and solar photovoltaic technology sits at the center of that transition. The challenge: every solar panel uses silver paste in its cells to capture and convert sunlight. Multiply that by millions of installations across continents, and the scale of silver demand becomes staggering, and it's not temporary. These panels need to be replaced, upgraded, expanded. The cycle doesn't end, it compounds. Electric vehicles only reinforce this trend. As the world phases out combustion engines and embraces EV, it introduces a whole new layer of silver demand. Not just in the battery systems, but in the inverters, the charging stations, the onboard electronics. A single electric vehicle can require up to twice as much silver as a conventional car. Now extend that across the accelerating adoption curves in China, Europe, and North America, and you begin to understand what compounding industrial demand looks like in real time, and perhaps the most underestimated factor of all: artificial intelligence. As AI scales, it demands infrastructure, server farms, high-frequency data transfer, machine-to-machine communication. These aren't abstract ideas, they're physical systems, systems built with materials that can handle speed, load, and precision. Again, silver shows up, not because it's trendy, but because it performs better than any substitute. This is the nature of structural demand. It doesn't ebb and flow based on sentiment. It's built into the architecture of progress. And unlike gold, which is largely held for monetary hedging, silver is being consumed, literally disappearing into the products we rely on every day. That means less of it is coming back to the market. Recycling can't keep up. Mining isn't scaling fast enough, and the pipeline for new discoveries is limited, expensive, and slow moving. So while the headlines may focus on price, the real story is happening quietly beneath circuit boards, inside solar farms, under the hood of EV, in the cooling systems of data centers. Silver is being used up, not just stored. That kind of consumption doesn't correct with time, it intensifies, and when that truth becomes widely understood, the revaluation isn't optional, it becomes inevitable. Markets are often emotional in the short term, but rational over time. When they drift too far from underlying reality, forces eventually converge to restore balance. One of the clearest signals of this dislocation today lies in the gold to silver ratio, a simple but powerful metric that reveals something critical. Silver is, by historical standards, significantly undervalued. This isn't just an opinion, it's an observable deviation from long-term norms, and if you understand how cycles work, you understand what this deviation implies. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. For most of modern history, this ratio has fluctuated between 40 and 60, but in recent years it has ballooned, at times exceeding 80, even touching 100. That's not normal. That's a system signaling stress, distortion, or both. And when markets move that far from historical equilibrium, they tend to snap back with force. Now, some argue this is just a reflection of silver's higher volatility. They're not wrong. Silver is more volatile than gold, and its price tends to swing harder in both directions. But volatility doesn't explain the structural divergence. What we're seeing isn't just a byproduct of price action. It's a divergence between perception and use. Case reality. Gold is hoarded. Silver is consumed. And in a world increasingly dependent on the industrial applications of silver, especially across renewables, technology, and digital infrastructure, it doesn't make sense for silver to lag so far behind. What's more telling is that during periods of monetary instability, inflationary pressure, or major geopolitical shifts, silver historically plays catch-up fast and often overshoots. It happened in the late 1970s, it happened in 2010, and it can happen again. In each of those cycles, the gold to silver ratio contracted dramatically, not because gold fell, but because silver surged. The market, realizing its mispricing, rushed to correct it. This is where the current setup becomes so compelling. Gold has already made significant moves in response to economic uncertainty, inflation expectations, and a breakdown in trust in fiat systems. Silver, however, has been slower to respond, not because it lacks fundamentals, but because its price is still shaped by outdated narratives. That lag creates an opportunity. When the market starts repricing silver in line with its industrial demand, relative scarcity, and monetary characteristics, the ratio won't need to drop to historic lows to produce major upside. Even a normalization to the 60 level would imply a substantial revaluation of silver from current levels. And if the market overshoots, as it tends to do during transition points, the returns could be even more asymmetric. But this isn't about chasing numbers, it's about understanding imbalance. When one asset outpaces the other beyond the bounds of logic, the imbalance builds tension, and in capital markets, tension always finds release. Not immediately, not predictably, but inevitably. That's the essence of mean reversion. The further you deviate from equilibrium, the stronger the pull back toward it. It's also important to remember that the gold-silver ratio is not just a technical indicator. It's a reflection of how investors value risk, utility, and protection. A high ratio suggests silver is being treated more as a speculative afterthought than as a critical input into the global economy. But as the real-world uses of silver continue to grow, and as monetary conditions remain unstable, that perception will change. When the rebalancing comes, it won't be polite. Markets don't whisper, they shout. And for those paying attention, the current gold silver divergence isn't just a chart anomaly, it's a roadmap. A roadmap pointing not just to potential gains, but to a shift in how value itself is understood. The correction may start slowly, but once momentum takes hold, it accelerates with a force that leaves most people wondering how they missed something so obvious. Most people misunderstand volatility. They see it as chaos, as danger, as a reason to avoid. But if you step back, if you look at the deeper mechanics of how markets work, you'll see volatility for what it really is, the price of participation and the signal of misalignment between perception and reality. Silver, in particular, has always carried this trait. It moves more sharply than other assets. It overshoots in both directions, and that very nature, while frightening to the unprepared, is precisely what makes it powerful for those who understand it. There's a reason silver has earned a reputation for being gold on steroids. It reacts faster, it climbs harder, and it falls deeper. And yet, if you zoom out, the long-term trajectory shows one consistent truth. Volatility has never changed the fundamental value of the metal. It has only made its journey more dramatic. What drives that drama is a combination of factors. First, silver's dual identity. It's both a monetary metal and an industrial one. That means it doesn't just respond to inflation, interest rates, or currency moves. It also reacts to real, world demand from technology, energy, and manufacturing. When both sides of that identity are pulling in the same direction, volatility doesn't diminish, it amplifies. But here's the key: volatility doesn't mean risk unless you're unprepared. It doesn't mean loss unless you panic. In fact, for those who understand cycles and structure, volatility becomes a tool. It allows entry when others are fearful. It creates mispricings that don't last. It flushes out weak hands and sets the stage for repricing. And silver, more than almost any other asset, has demonstrated this pattern again and again. Look at the major runs in silver's history. In the late 1970s, prices went from under $6 to nearly $50 in a parabolic move. In 2010 to 2011, the metal did it again. These weren't accidents. They were the natural result of underlying pressure building through long periods of sideways movement, consolidation masked as stagnation. When those pressure points broke, the move was violent. And yes, after each move came correction, but those corrections didn't erase the trend. They simply reset it, preparing for the next phase. This is where most investors get shaken out. They treat volatility as a flaw rather than a feature. They assume that a sharp drop signals a fundamental change, when often it's just the market recalibrating before moving higher. That's especially true with silver, which has a relatively small market compared to gold or equities. It doesn't take much capital to move the price significantly. That thin liquidity, combined with its emotional narrative history, creates a fertile environment for swings. But again, volatility is not randomness. It's a reflection of sensitivity, how quickly the asset responds to changes in perception, policy, and positioning. If you understand the underlying structure, volatility becomes predictable, not in exact timing, but in behavior. And that predictability is what creates opportunity. The core idea is this: if you believe in the structural demand story behind silver, driven by renewables, electronics, AI, and monetary dynamics, then volatility becomes a gift. It lets you build position at lower levels. It lets you watch fear displace reason, and it gives you the chance to benefit when balance is restored. To be clear, this isn't about blind optimism. It's about discipline. Volatility tests conviction. It shakes the impatient. But for the thoughtful investor who understands not just what silver is, but what role it plays in the system that's emerging, volatility isn't the thing to avoid. It's the thing to embrace, because in the end, the greatest opportunities are rarely found in straight lines. They're found in the sharp turns that most people run from. So is now the time to invest. If you seek safety, perhaps not. But if you seek transformation, if you listen to the logic beneath the noise, then yes, this isn't about hoping for silver to rise. It's about seeing why it must. The wave is forming. Ride it well.